Ahoy me hearties and welcome to the Pirate Traders YouTube page. Today I want to talk about a book that I've been reading called Tribe of Mentors by Tim Ferriss. It's a really cool book. Basically what he did was he sent like all these really famous successful people the same like 7 or 8 questions and had them all answer them, and it's just so full of valuable information. And one cool thing that I'm noticing is that there's a lot of trends in things. For example, one thing is a lot of people, like 75% of the people in this book, talk about meditation as a way to focus their mind and help them control their emotions. And I just think that's so powerful. A lot of people talk about habits like going for walks and things like that, things we talk about on the channel all the time. I was just reading through the section about a guy named Adam Robinson. He was a former chess master. He's a genius. He's a writer. And he also helps hedge funds and stuff like that develop trading strategies. One of the questions that Tim asks is, what are bad recommendations you hear in your area of expertise? And one of the things that he talks about in this is confirmation bias, and I think it's just such a powerful concept and such a powerful idea that I wanted to make a video about it. And then I realized instead of like writing my own script on it, why don't I literally just read you the section from the book? So this video is just me reading to you from Tribe of Mentors in the Adam Robinson section, page 190. If you've got the book. Virtually all investors have been told when they were younger, or implicitly believe, that the more they understand the world, the better their investment results. It makes sense, doesn't it? The more information we acquire and evaluate, the better informed we become, the better our decisions. Accumulating information, becoming better informed, is certainly an advantage in numerous, if not most, fields. In 1974, Paul Slovic, a world-class psychologist, decided to evaluate the effect of information on decision-making. This study should be taught at every business school in the country. Slovic gathered 8 professional horse handicappers and announced, "I want to see how well you will predict the winners of horse races." Now, these handicappers were all seasoned professionals who made their living solely from their gambling skills. So they're basically like traders, but instead of trading financial assets, they trade on horse races, okay? But they're professionals. So finally, in addition to asking the handicappers to predict the winner, he asked each one to also state how confident they were in their prediction. Now, as it turns out, there was an average of 10 horses in each race, so we would expect by blind chance, randomly guessing, each handicapper would be right 10% of the time, and that their confidence with a blind guess would be 10%. So in round 1, with only 5 pieces of information, the handicappers were 17% accurate. 70% better than the 10% chance they started with given 0 pieces of information. And interestingly, their confidence was 19%, almost exactly as confident as they should have been. They were 17% accurate and 19% confident in their predictions. In round 2, they were given 10 pieces of information. In round 3, 20 pieces of information. And in the 4th and final round, 40 pieces of information. So basically, why am I talking about this? Why am I talking about these handicappers and the information that they've been given? Well, this is what happens to traders when we're trading, right? We have these complex systems that we develop where we're looking at dozens of different signals. Some of them are market generated, some of them are news generated, some of them are just our own intuition generated, and we have all this information coming in. And a lot of traders think the more information that they have, the more signals that they're looking at, the more pieces of technical analysis that they're analyzing, the better off they are. Like the more information that they have, the better trader they are. But what this is about to tell us is that less information is actually better, and I'll explain why. However, in round 4, surprisingly, their accuracy had flatlined at 17%. They were no more accurate with the additional 35 pieces of information. Unfortunately, their confidence doubled to 34%. The additional information made them no more accurate, but a whole lot more confident, which would have led to them increasing the size of their bets and losing money as a result. So this is where it gets interesting, right? The way the human brain works is that if we have more pieces of information to look at, we trust it more. We have more confidence in it, but it's not actually any better. Statistically, it's the same accuracy, but we just have more confidence in it. Very interesting. Okay? Beyond a certain minimum amount, additional information only feeds what psychologists call confirmation bias. The information we gain that conflicts with our original assessment or conclusion, we conveniently ignore or dismiss. while the information that confirms our original decision makes us increasingly certain that our conclusion was correct. So what does this mean? So this means if you have a bias on the market, right? You think the market's going to go up today. And what you're looking at all this different information. You're looking at this chart and this technical thing and that signal, and you're looking at the news and you're looking at what's happening in all these other markets. Oh, oil's going up today and the dollar's going down, and all of this means that the market's going to go up. Like, if you're looking at all this information, what you don't realize your brain is doing is it's picking and choosing what to pay attention to. It's focusing on the information that corresponds with what you already want it to tell you, what you already believe, rather than being open to all the information that's available. Instead of saying, I think the market's going to go up, let me look for things that are going to correspond with that, we have to be constantly looking for how we are wrong. What market-generated information is telling us the opposite of what we think? That's telling us that maybe we should get out of a trade. And then we have to learn to, the moment we start to see that information that our trade idea is wrong, we have to exit the trade without hesitation or reservation. So, to return to investing, the second problem with trying to understand the world is that it is simply far too complex to grasp. The more dogged our attempts to understand the world, the more we earnestly want to explain events and trends in it. You hear it all the time from even the most seasoned investors that this trend or that doesn't make sense. It doesn't make sense that the dollar keeps going lower, or it makes no sense that stocks keep going higher. Because financial trends involve human behavior and human beliefs on a global scale, the most powerful trends won't make sense until it becomes too late to profit from them. By the time investors formulate an understanding that gives them confidence to invest, the investment opportunity has already passed. So when I hear sophisticated investors or financial commentators say, for example, that it makes no sense how energy stocks keep going lower, I know that energy stocks have a lot lower to go, because all those investors are on the wrong side of the trade, in denial, probably doubling down on their original decision to buy energy stocks. Eventually, they will throw in the towel and have to sell those energy stocks, driving prices lower still. So this is obviously a really powerful conceptual idea that we all need to think about on a day-to-day basis. Our brains have confirmation bias. If you're a human being, you've got it. You've got confirmation bias. Your brain is not perfect. It is just showing you what it wants you to see. And so as soon as you start to create biases about what you think the market's going to do, whether you're thinking about what it's going to do over the next hour or over the next 10 years, once you have a bias, your brain is going to start blocking out information that does not confirm that bias. And that is the trick that you have to develop a skill for overcoming that, right? For being able to say to yourself, am I wrong in this trade? And if I was, how would I know? So that's why as a day trader, I'm constantly keeping in mind this idea of what are all the potential things the market could do. Sure, I think it's going to go up, and if it goes up, this is what it's going to look like. But what would it look like if it was just going to go sideways? What would it look like if it was going to go down? I keep all those ideas in my head so that all the information is available to me. My mind isn't blocking anything out because I believe anything can happen. If anything can happen, I have to be open to all the market-generated information. I can't just pick and choose which go with my confirmation bias. All right, guys. Thank you so much for watching. If you enjoyed this video, please smash that subscribe button, hit that notification bell so you can be kept up to date when I drop more content like this. And as always, please hit that like button to support the channel. Thank you guys so much and have a great rest of your day.